Okay, let's unpack this. Staying informed is just crucial, especially when it comes to investing your money.
Absolutely. The landscape's always changing.
Exactly. So today, we're doing a deep dive into something pretty fascinating: alternative investments.
Right. A bit different from your standard fare.
Totally. We'll look at, what they actually are, why you might consider them. The risks, definitely need to talk about risks and
Hmm.
how they're set up because that differs quite a bit too. Think of this as your shortcut to getting a handle on this whole asset class.
Sounds good. Where should we start?
Let's start right at the beginning. What exactly are alternative investments? What falls under that umbrella?
Well, simply put, they're investments that aren't your typical stocks, bonds, or cash. That's the basic idea.
Okay, not the usual suspects.
Right. And we generally see them in maybe three main buckets. You've got alternative strategy funds. They use specific methods.
Okay,
Then there are alternative assets. These are often physical things. And finally, private equity.
got it. And those alternative assets, you said physical things. What kind of examples are we talking about?
Yeah, often tangible. Think commodities, like agricultural products, metals, energy.
Mm-hmm.
Real estate is a big one, commercial, industrial, residential. Even REITs fall in here.
Right, real estate investment trusts.
Exactly. But it gets even more diverse.
Right.
You could have collectibles like art or classic cars, infrastructure projects, roads, ports,
Wow.
and even things like timberland or farmland, natural resources.
Okay, that's a really broad range. So why would someone who's already got stocks and bonds look into this space? What's the big benefit?
I think the biggest draw for most people is diversification.
Okay.
These assets often don't move in lockstep with traditional stocks and bonds. They have a low correlation.
Meaning if stocks go down, these might not.
Or not as much, yeah. So adding them can potentially lower your portfolio's overall choppiness, its volatility. It offers what we call downside protection, especially when markets get stressed.
Right, right. And it's not just about smoothing the ride, is it? I've heard about this concept, the efficient frontier.
Ah, yes. That's a key point.
Oh.
Alternatives can potentially shift your entire portfolio onto a higher efficient frontier.
Which means better returns for the same risk. Or maybe the same return, but with less risk.
Exactly that. It's about optimizing your risk-return trade-off, pushing beyond what traditional assets alone might offer.
Okay.
And there's more. Alternative fund managers often try to generate alpha.
Alpha. That's return above the market benchmark.
Precisely. They aim for absolute returns, trying to make money whether the market's generally up or down.
How do they manage that? Sounds tricky.
Well, they often have more tools in their toolbox than, say, a conventional mutual fund manager.
Like what sort of tools?
Things like short selling betting on prices going down, using leverage, which is borrowed money, to amplify potential returns.
But also losses, I imagine.
Absolutely. Leverage cuts both ways. And they use derivatives, complex financial contracts, much more freely. These strategies are often restricted for regular funds.
Okay, makes sense. But that leads us straight into risk, doesn't it? More tools, maybe more potential reward, but definitely more complexity and risk. How do we even measure risk here?
That's a great question. And honestly, there's no single perfect measure, but we often look at volatility standard deviation, how much the price bounces around,
Right.
and also drawdown, that's the peak to trough decline, the maximum percentage drop a fund experiences.
Got it. And are there different types of risk specific to alternatives?
Yeah, we can sort of categorize them. You have first-order risks. That's just your basic exposure to broad market movements. Equity risk, interest rate risk, currency fluctuations.
The usual market stuff.
Right. Then you get into second-order risks. These are more about the trading itself. Liquidity risk is a big one.
Difficulty selling when you want to.
Exactly. Can you get your money out quickly without tanking the price?
Yeah.
Then there's leverage risk, which we mentioned. Default risk if counterparties fail. Concentration risk, putting too many eggs in one basket, basically.
Okay, so trading and strategy risks. Anything else?
There's also operational risk. This relates to the fund as a business. Think about potential system failures, bad procedures, or maybe relying too heavily on just one or two key managers if something goes wrong inside the fund.
That could impact returns, regardless of the market.
Right. Okay, let's switch gears slightly to the structures. How are these investments actually packaged? Hedge funds seem like the classic example.
They are. Historically, hedge funds were really only accessible to very wealthy individuals and institutions.
Why was that?
Mainly because they face lighter regulation, which gives them huge flexibility in their strategies. But it also means less investor protection, traditionally.
And their fees are different too, right? High watermarks.
Yeah, they often use incentive fees. A high water mark means the manager only gets paid a performance fee on new profits above the previous peak. So they don't get paid twice for recovering old losses.
Correct. And sometimes there's a hurdle rate. The fund has to earn a certain minimum return before that performance fee kicks in.
Interesting. And liquidity.
Generally much less liquid than mutual funds. You might only be able to get your money out monthly or quarterly, and there are often lockup periods where your capital is tied up for, say, a year or more.
Okay, so pretty restrictive. But things have changed, haven't they? We now have liquid alts.
Yes, exactly. Alternative mutual funds or liquid alts. These became available to retail investors here in Canada back in October 2018.
So they bridge the gap.
They try to. They offer access to some of those alternative strategies, but within a familiar mutual fund structure. That means daily liquidity, you can buy and sell daily, plus more transparency and regulatory oversight.
More protection for the average investor.
Right. Now, they do have more flexibility than conventional mutual funds. For instance, they can short sell up to 50% of their net asset value, their NAV, and use leverage up to 300% of NAV, which is significant. But they're still more constrained than a typical hedge fund. And their performance fees are usually lower too, maybe around 8% versus 10-20% for hedge funds.
Got it. And what about funds of hedge funds? Are they another option?
They are. A fund of hedge funds, or FOHF, is basically a portfolio of other hedge funds.
Ah, diversification within the alternative space itself.
Exactly. The advantages are you get professional managers doing the due diligence on the underlying funds, potentially reduce volatility because you're spread across different managers and strategies, and maybe access to funds you couldn't invest in directly.
Makes sense. What's the downside?
Well, the main one is layered fees. You're paying fees to the FOHS manager and the underlying hedge fund managers. So costs can be higher. And, of course, there's still no guarantee of positive returns.
Right. And quickly, ETFs. Do they play here too?
Yeah, definitely. They're now exchange-traded funds that incorporate certain alternative strategies. And the benefit there is you can trade them throughout the day on an exchange, just like a stock.
Okay, lots of different ways to access these strategies then. So if we try and pull this all together, what's the main takeaway when choosing between these?
Look, it really boils down to a trade-off, doesn't it?
Yeah.
Hedge funds might offer higher potential returns, but often that comes with higher risk, less transparency, and definitely less liquidity.
Right.
Liquid alts, on the other hand, they tend to offer maybe slightly lower returns, but generally at lower risk, and you get that daily access and stronger regulatory protection.
So more accessible, perhaps safer, but maybe less upside potential.
Generally speaking, yes. Although it's interesting, during really tough market periods, those times of distress, the actual return differences between hedge funds and liquid alts sometimes narrow quite a bit.
That is interesting. So the extra risk in hedge funds doesn't always pay off when you need it most.
It's not guaranteed, no. Which really brings us to the key question for you, the listener.
Yeah.
Knowing all these differences, these nuances in risk, return potential, liquidity, fees, how do you figure out what actually makes sense for your specific investment goals and, just as importantly, your comfort level with risk? That's the real puzzle to solve.